All right, and moving on, as India prepares its upcoming budget, a mixed macro picture sets the stage. Big private investment remains elusive, while global uncertainties and volatile risk assets shape the current environment. Economic trade-offs remain challenging, yet consolidation of government finances is set to continue. In this next report, we look at how India will look inwards with reforms for strengthening domestic economy amidst a volatile geopolitical backdrop. Take a look.
The Indian economy is doing well, but foreign investors have been selling Indian assets at a rate not seen in years. On February 1, India will unveil its annual budget that will put the country's ability to entice investors through accelerated economic reforms to the test. The key question for investors is, will the government turn towards long-term reforms or turn to temporary stimulus as it did last year? For now, India continues to face resistance from international investors. That is, despite the country's status as the world's fastest growing major economy. A fresh push for long-term reforms have not really helped. Those reforms include modernization of labor laws and the relaxation of regulations in the financial sector. Still, foreign investors have sold a total of $22.6 billion worth of Indian stocks since January 2025. Economists argue the budget should prioritize domestic economic reforms that attract more foreign investment. Their suggestions include simplifying customs regulation, which currently make doing business in the country challenging. Economists also caution against relying too much on the sugar high of recently announced tax cuts. They say any relaxation of fiscal policy would frighten away foreign investors and speed up the sell-off. The focus of spending will likely remain on long-term infrastructure projects that generate jobs. India is not likely to look at providing a quick boost to growth, despite the government's aim for a $5 trillion economy at the earliest. A Reuters report quoting official sources showed India's goal is to increase exports threefold by 2035. The budget is expected to focus on manufacturing and implementing structural changes instead of relying on large-scale investment. According to the Reuters report, the country aims to increase yearly goods exports to $1.3 trillion, accelerate economic growth by focusing manufacturing on 15 key industries including metals, labor-intensive leather production and high-end semiconductors. The allocation is likely to show 100 billion rupees or $1 billion to build infrastructure for about 30 manufacturing hubs across the targeted sectors, provide grants of $218 million for advanced areas such as chips and energy storage. This year, financial support to industries will likely be decided case by case. The plan is to replace the pre-budget fiscal packages of earlier schemes and use focused spending to rein in fiscal deficit. Business Bureau, WION World is One.
And for more on this, we're now being joined by Dr. Andrew Freris, CEO of Econosis Advisory Limited. Welcome to the broadcast, Dr. Andrew.
Thank you.
Foreign investors have sold over $22 billion in Indian equities since January 2025. Now, having said that, is this a confidence issue or a valuation reset amid global risk aversions, according to you?
You know, there has been an obsession over the last year about the foreign selling of Indian shares without asking the important questions why they were doing this. They were doing this, A, because the weakness of the rupee, because the high valuation of both of the Sensex 30 and of the Nifty 50, and of course the poor performance of these two indexes. Now, this becomes sort of dog chasing its own tail, because of course if people are selling, then prices come down, then the indexes come down, and then of course that encourages people to sell more. Nonetheless, at the end of the year, both the Nifty 50 and the Sensex were just about the worst performing indexes in the whole of Asia. Something like between them, something like between 5 and about 3% overall performance. Very, very poor indeed. Now, again, what caused that? It could have been partially the response to an initial drop, and then, of course, the expensiveness of the indexes themselves, concerns over inflation at the time, and also, of course, interest rates, the weak rupee, and, of course, let's not forget, 25 was a horrible year in which India was absolutely pressurized by the Trump administration, including Brazil, with huge threats of 50 and 60 and 70, I don't know what percent, unless and something happened, and unless India, of course, stopped importing Russian oil. All these were not helpful at all. I mean, this was, in the sense, pure politics as opposed to just economics. So whether the performance of the stock market is going to improve next year will be the absence of any further jars like that. And I guarantee you there will not be any absence. Trump will continue the continuous process of shock and awe of inconsistently consistent absurd economic policies. He's already threatening to impose tariffs on South Korea because South Koreans apparently are refusing to invest as much as they had before. So I would like to see now what will be Trump's reaction to the huge trade deal between India and the European Union. It took 20 years. The deal between India and the UK, also I thought that took something like between 4 and 6 years. Very important stages where India says we are continuing to engage ourselves in a multilateral, rules-related economic policy.
Absolutely,
Trump
Dr.
doesn't
Andrew.
like that at all.
Right, and while we stand at a very critical juncture, how do global investors view India's ambition in advanced manufacturing as compared to China, Vietnam, or let's say Mexico?
I'm afraid my reaction to that is investors buy and sell on a fairly short-term vision. So now whether India is producing high-quality technological goods in the next 5 years will be, frankly, it will be completely outside their own vision. Things like moving from China to India, the Apple manufacturing, which is sort of went very quiet recently, was a good start. I'm afraid I'm going to end my little discourse on the industrialization of India, and that is with my favorite sector, defense. India is a major importer of military goods and should become a major exporter of military goods, and that is a very good way of stimulating shipbuilding, aircraft building, electrical engineering, steel, and of course software. I know it's horrible to say India should be producing goods to kill other people, but it's not a matter of killing other people. It is any country that doesn't have a big, strong, modern defense sector, okay, is likely to be pushed around by anybody that feels like doing it. And India is a big country with a big economy and should have a commensurately big defense sector. And investing in the defense sector, for me, it's a very good way to boost the desire for greater manufacturing in India.
Absolutely, and with the big ambitions, I may add. Now, having said that, what single reform signal in the budget would most reassure the global capital markets, according to you?
I'm afraid I have read a whole section, particularly when I read about reforms following the income tax reform of 2025. I must admit, I must be very stupid or not very well equipped, because it is incredibly complicated in the sense all the different little sectors that are removing and putting up deductions between this and that, and what's going to happen to the deductions of payments of life insurance, of health insurance. And frankly, international investors are not going to be particularly enamored by seeing a big book like that full of reforms of the income tax or the corporate tax. Now, allowing greater participation in India's financial sector, like, for example, there has been a long-term standing involvement in India's insurance policies, insurance industry, is always good news. But unless there is something quite dramatic, and I'm afraid I can't see anything that Modi will sit down and says, okay, let's really reform X sector just to shook up, okay, the international financial markets. That's not going to happen. So I'm afraid I don't expect that at the end of the budget presentation, Sensex is going to leap up by 10 or 20%. I'm not being sarcastic, I'm just being realistic.
Right, we hear you, Dr. Andrew. Thank you so much for joining us on the broadcast and sharing your insights with us.